Okay, great. So people will probably be logging in as we go forward, but I think we go ahead and get started. So good morning or good afternoon, depending wherever in the world you are. Usually for these type of events, we'd be speaking in United States terms, but this event's actually gonna have a global audience. So wherever you are in the world, good morning, good afternoon, whatever it may be. We are pleased to bring you Gateway Group's first ever virtual ESG panel. It is our goal that this will be an ongoing thing. We're thinking maybe once a quarter. It will be a series of panel discussions on different ESG topics. And our goal is to try to get as much information as we can out there for everybody. Just for way of background, Gateway is a comprehensive capital markets and public relations consultancy firm that has been leading in the industry since 1999. This past year, we announced the launch of our ESG advisory that would be led by myself, Lucas Doub. It is our goal that our clients, partners, and the public has access to some of the best information out there in regards to ESG. We hope that virtual panels like this with the experts that we're going to hear from today will help provide more insight on what's going on out there. Not only is it my pleasure to lead this practice and to take charge of this initiative and to help our clients and prospective clients and so forth, but we also wanted to bring in experts. And for today, we have Brian Matt from the New York Stock Exchange, Krista Bosnia from Ecology. I never really say it right. Sorry, Krista. And John Miller from Cowen. And I will, Krista, if you want to start, I'm just going to let you guys give a little background on yourself and a little introduction of what it is that you do, and then we will go from there.
Great. Thank you so much, Lucas. And thank you so much for everyone tuning in. It's so exciting to have this discussion today. I'm Krista Bosnia, Head of Marketing at Ecology. We're a subscription service for the planet. We call ourselves the Spotify of sustainability. Started out a couple of years ago just as a subscription service where businesses and individuals can fund climate solutions on a monthly basis. But now we're moving more towards the area of carbon accounting and helping businesses achieve net zero. My personal background is in marketing and storytelling and how do we engage the masses around taking climate action. And I have a long history of working for big corporates in the travel sector, like Heathrow Airport and TUI, the tour operator, big FTSE 500 companies, and really seeing how sustainability can be embedded and integrated throughout. So yeah, really excited to have this conversation today.
Great. John, why don't you give us your introduction?
Sure. Thanks, Lucas. Thanks for having us. My name again is John Miller. I work at Cowen. Cowen's an integrated investment bank and broker dealer. I sit on the research side, specifically within a team domiciled in very warm, very muggy Washington, D.C. So we're not burning down the house here, but it is in the 90s and a 90% plus on the humidity side. So just constant suffering. Obviously, sitting in DC, we cover policy. My specific vertical is around what we've defined as ESG and sustainability policy. And the concept there is that as ESG investment frameworks really begin to formalize their expectation of what the future is going to look like, either from the environmental perspective or human capital management or good governance, underlying regulations and public policy is going to have to shift to accommodate that. And if it doesn't shift, there'll be implications for that timeline for sure. My role is very much one part of Cowen's overall ESG efforts. All of our fundamental equity analysts consider ESG in their ratings and price target decisions and in our banking team as well. So that's me. I'll turn it back to you, Lucas. Thanks so much.
Great. And Brian, we'll hear from you as well.
Sure. I work for the New York Stock Exchange. This is the library of the New York Stock Exchange at 11 Wall, corner Wall and Broad. Joined about 18 months ago. Prior to that, worked for IHS Markit. I ran a ESG consulting business for Americas inside IHS. But spent much of my career before that in corporate investor relations, going back to the late 1990s with the Carson Group and with IPRIO as a IR consultancy later on. So really my core stakeholder that I've worked with consistently has been investors, helping companies tell their investment stories out to the investment community. Of course, ESG has become an increasingly important part of that investment story. Obviously at NYSE, we're involved in advocacy, so somewhat of John's territory when it comes to regulation and policy. But my primary role is to work with NYSE's 2,400 listed companies, as well as new companies coming on board, and work with them to start scoping out what their ESG story should be and how they should tell that, both to that investor as well as other stakeholders as well. So great to be here. Thanks for the invitation.
Well, I appreciate all three of you all joining and making time for this. So again, my name is Lucas Doub. I'm the head of ESG for the Gateway Group. For just way of background, I've worked in investor relations for 15 plus years, mainly on the vendor side in the business development realm. I would oversee our channel partners and agencies. Most of that time spent with NASDAQ, actually. But stuck inside during 2020, just like the rest of us, and seeing some of the events going on in the world, I decided to really shift my career to being focused on ESG. It was something I really was excited about and believed in. And for the last few years, I've really spent time getting integrated and learning as much as possible, and now helping advise our clients on what I think they should be doing and how they should communicate these efforts. And so this is a very exciting moment for myself, but I think it's an exciting moment for Gateway as well, because we are really going all in on this initiative. So, to skip ahead a little bit, I mean, we could do an ESG 101, but I think everyone here and everyone that's listening probably understands a little bit of the environmental, social governance, and in relation to the stock market and to other initiatives that corporations are doing. There have been tons of webinars, tons of information out there, and so forth. But as we all know, it has been growing quite a bit in popularity. It is a subject that is talked about endlessly at every event that you can imagine. We've seen growth after growth after growth, year after year, lots of growth in the ESG space and what that means, and when businesses are starting to shift, how they look at it and do it and so forth. So I have two interesting sets of statistics here. They're almost converging here for us to start, and then we'll get into the Q&A and the discussion. So, in 2020, Bank of America did a survey that found that 90% of millennials plan on participating in impact investing. And in 20 or 30 years, millennials will be responsible for investing about $15 to $20 trillion. So you can't really ignore that number. 76% of consumers say they will stop buying from companies that treat the environment, employees, or the community in which they operate poorly. I think that is a great stat as well of what we're seeing consumer in. And sometimes when we talk about investors, they can mean kind of the same thing. And in 2022, PwC did a survey on investors. 75% believe that companies should address ESG issues, even if doing so reduces short-term profitability. And 49% are willing to divest from companies that aren't taking sufficient action on ESG issues. So as we can see, this is real now. This isn't just a talking thing, it's actually happening. And now the other side of what's going on. At the end of Q2, we saw the worst first half of the year start for the US equity market since 1970. Tech, which has mostly been seen as kind of a progressive beacon in ESG strategy, has been particularly hit hard. The current inflation rate is a staggering 9.6%. Every single one of us are now feeling that. That is the largest in 40 plus years. And while it has leveled off a bit and come down a little bit, all of us have seen the increase in fuel cost. And that has been caused by numbers of factors, a lot of things, and Krista could probably know this, the war in Europe and other things going on. But there's certainly, when you get hit the pump, that has a way of hitting everything else that you're doing. And we're seeing that as well. Supply chain issues continue. We still have issues with figuring out tariffs and the cost of goods and labor. And as I mentioned before, world conflicts are adding to this pressure as well. A lot of uncertainty. It's a little scary out there. While the job numbers in the United States still remain pretty good, the last few job reports have looked really good. If you just go on your LinkedIn newsfeed, you are starting to see some layoffs and starting to see people announce layoffs. And while we don't see exact stats for that yet, you can just do it with your own eyes. We see that that's happening. And the Fed has begun raising interest rates to help cool off inflation. As a personal example, my wife and I purchased a home in Los Angeles in November of last year, and we got it at 2.62% interest. If we were to buy that same home today, 7 months later, we would probably be looking at about 7% interest. So that is a big change in what's going on. And so, yeah, the definition of a recession is 2 straight quarters of negative GDP. We had negative GDP last quarter. We're now just starting earnings. I would have to imagine they're not going to be great. So maybe we should call it that we're in a recession now. If it's not called a recession, it's definitely a different type of economy than we're used to. It's some sort of bear market downturn, and certainly with just the inflation, just the cost of living for people has gone up quite a bit. And so what we wanted to do today, and this will probably, and we'll start with Brian. This will be the first really webinar, virtual panel, or anything where the title of it is the lead question, and we just go right into it. And so the question is basically, if we are heading into a recession or a downturn in the economy, will ESG remain a priority? Will this be seen still from on the investment side as something that is a push on Wall Street, something that they are getting excited about, or does it get pushed aside and now we have to focus on just purely profits, revenue generation, and do companies need to shift? You know, a lot of money has been spent from companies on these practices. Do they now need to just focus on surviving for the next year or two? So Brian, we'll start with you, and then we'll leave it from an open conversation from there.
Sounds good. All right, so definitionally, first off, the way I would think of your term ESG here really starts for us the way I think of things is NYSE. The shareholder, our job is to connect companies with investors. So I normally think of the shareholder as the primary stakeholder, although there are other stakeholders involved in working with every organization. So when you think about investors and you think about financial materiality, we're already talking about just ESG items for companies that are financially material, that are important and could have an impact on top line, bottom line, however you define it. If we separate out philanthropy and we think about just how investors make decisions on financially material items and how companies make decisions on financially material items, I think you do see some evidence if you consider what you've started to look at from fund flows just from the start of the year. You saw outflows from essentially every type of active portfolio. You saw outflows overall from investment portfolios, but you actually didn't see as deep a percentage of outflows from ESG-focused active funds during that period. You also saw, and I think actually just this morning, while we did have a month of outflows from ESG funds, you actually started to see inflows again based on the data from Morningstar. Overall, I think when you think about active mutual fund management, you think about every active manager that's out there, ESG is really a differentiating point for those active managers. John, your team obviously is going to face these customers as you face out to your buy-side relationships. That's increasingly become one of the primary differentiating factors for asset managers in being able to differentiate themselves versus passives as well as against each other. So I just say from at least in the couple of quarters that we've seen in terms of weakening price performance in the market, we haven't really seen as much of an outflow of assets from ESG dedicated portfolios. No guarantee that doesn't continue, but at least the stats there would point us in that direction. Now, when we think about each company, when we think about the decisions that each company is going to make in terms of capital allocation, in terms of spending, et cetera, that's really when you start to think about who are the stakeholder groups that each of those decisions are affecting. And are those stakeholders making decisions that are more cyclical in nature or more non-cyclical or operate outside the business cycle? I would contend investors are already operating in a lot of cases outside the business cycle when they have 3, 5, 10-year holding periods. A lot of those longer-term investors already think in those terms, and especially dedicated ESG funds do. But then when you think about employees do think in terms of longer than business cycle terms. Your expected tenure for employees may be longer than a very short recession or a short business cycle. When you think about how customers make decisions, sometimes customers, if they're looking at your products or your services, they're making decisions not for 6 months, but for a year, for 2 years, for 3 years. The work that you do to present your business and everything that you do as your business really should be reviewed based on what your stakeholders think and potentially split between what's a cyclical decision versus a longer term or outside of cyclical decision. We can get to later, but obviously governments and regulators do not really think in terms of business cycles. They're pushing forward with some of the demands for disclosure and communications, whether we have a strong or weak business cycle at any point in time. I think John and Krista can get into that too. So that would be my first thought, is just simply splitting the thought process between what are the ESG decisions and commitments we're making cyclically versus non-cyclically, and how are our stakeholders thinking in those terms as well.
Great. John, Krista, did you have anything you'd like to add to the question?
I'm happy to jump in on that one for sure. And obviously, where I'm sitting with this specific role of speaking to institutional investors, and then trying to bridge that narrative between an investment framework and the public policy footprint that's in there. And I liked a lot of the word choice from Brian there, right? I actually have some notes put together because it's been a little bit of a frenetic 2 weeks here in DC, so my mind is kind of all over the place. And then this morning, it turns out the president has COVID. So, it's just been an interesting experience, but this is really important. And one of the questions that I get quite a bit from the institutional investors are around, what are those factors that are material? And so a material ESG factor is relevant in an up market and in a down market, right? If that factor you were looking at is no longer showing you an investment signal, it probably wasn't a material ESG factor to start with, right? So you might want to reassess that framework. I don't think it's going to be a surprise, but like our overall view here at Cowen is that ESG is only going to become more important in a market where capital allocation is more cautious, and there's just a higher and more fierce competition for the remaining investors in this space. So we see ESG moving from a nice to have to a baseline requirement. And Lucas, your comments about what we're seeing in hiring, I think it's very interesting. If you go on LinkedIn and look for ESG jobs in asset management, they're still hiring specialists. If you're looking for ESG jobs in debt capital markets and equity capital markets, still hiring jobs. Overall, the investment banking space is certainly looking at the next 18 months and has questions, but not for specialists with ESG. So companies that have those stories will have maybe not a lower cost to access capital markets, but access, right? If that's shut down for other pipelines. The core part of my job, right, is on the policy side. And Brian, I really like your comment around cycles, right? Policy cycles operate on a totally different rhythm than market cycles. That's not new here at all, right? And it's specifically not new for ESG. And I think one of the primary drivers of ESG as a capital markets function is the realization that public policy broadly, not just the US, but it's failing to keep pace with what society wants to see around environmental change and this concept of stakeholder capitalism. Ideally, that would come through legislative bodies. But since that isn't happening, other tools in the place are stakeholder capitalism and capital markets. So on mandatory disclosure, recession, not recession, that's coming. And in many instances, it's already here. So either in the US, the SEC can finalize its proposed rules, or large issuers in the US will simply be caught in the slipstream of what the European Union is doing, right? So that's happening. I think that, again, recession or not, peel this back, the SEC and the SEC's chair in particular are really focused on retail shareholder protection. And they say ESG as a place that there's a lot of information in the marketplace. It's not comparable. It's very difficult to unpack. The retail investor can get confused and potentially misled. It's not just ESG, it's things like SPACs and other types of capital allocation that have emerged over the past few years that this SEC is really paying attention to. So I don't see that changing no matter what the background of the capital market situation is. Now, a recession into a depression or something of that nature, maybe those things could change, but kind of the outlook now, that's going to continue moving forward. What's a little bit more interesting is sort of tabling the disclosure framework of what's going to happen on the environmental side. So in the United States, we've had a very challenging, let's say, past 30 days with our Supreme Court, which is effectively the arbitrator of what is constitutional and not constitutional, has really limited the scope of the regulatory state. And then in the past week, one individual, right, is able to effectively shut down more than $300 billion in long-term climate and energy spending. So that's certainly frustrating. We believe that this administration and President Biden in particular is going to use a lot of executive actions and raise costs for transportation sector, power sector, and industrial sector that produce emissions. They're probably waiting until after reconciliation here is done, maybe waiting until after the midterm elections, but those things are going to come. They won't be done through laws. They won't be transparent and clear, but they're going to be expensive and they're coming. So that was a lot for me, but I'll turn it back to you, Lucas. This is a great conversation.
Great, yeah, and basically also we'll get into it here in the next question. I had a lot of questions about public policy, but Krista, what do you see how this shaking out with companies here as if we are heading into an economic downturn, and what their priorities are going to become, and what are you seeing from your side of the pond?
Yeah, the European side of the pond. So we're based in the UK, although we have a growing network in the US as well. It's really interesting because just reflecting back on what we just started talking about, we definitely saw a shift in behaviors coming out of the pandemic. So during the pandemic, obviously, businesses were very much focused on staying alive, surviving, and individuals were at home, we're connecting a lot with the environment. So we saw a lot of pressure from consumers in 2020 and 2021. And now that we've come out of the pandemic, this has shifted 180 degrees. So we're seeing consumers resume life, and businesses now have a lot of pressure to act and to really show their ESG agenda, really push on that, achieve net zero, achieve significant carbon reductions across the business. So it's a very different environment. We've gone from a consumer interest to a very, very high business interest. Now at Ecology, we work with about 13,000 businesses now, and we hear this a lot. We hear, I don't know where to get started. I want to do something. 80% of businesses want to do something, but they don't know where to start. So the good news is that there's so many ways to get started. So some businesses that are product-based start small, and they say, okay, we'll plant a tree for every product that we sell. And that's, obviously a lovely thing to communicate to customers as well. Other businesses actually know the carbon impact of their product. They may have calculated or of their service, and then they buy carbon reductions to achieve carbon neutral status. They might do that. Other businesses that come to us maybe want a way to make their workforce climate positive. So they choose to put all of their employees on a plan that essentially reduces all of their emissions, including business flights, or they sometimes even choose to offset their entire workforce's personal lives, their entire lifetime emissions. One of the interesting things that I hear more and more from businesses is that they realize, and I know that we talk about investments a lot, that the actual real shareholder is the planet. So we need to keep that into perspective, and all businesses like I said, they're on their own journeys, and as you grow and you're a bit more advanced in your understanding of the impact of your business, you maybe do a robust calculation of your carbon emission. You get your scope 1, 2, and 3 calculated, and then you can either go 2 routes: carbon neutral, which basically just means offsetting buying reductions for your impact, or net zero, which means a very drastic 90% reduction of your emissions, and then you buy carbon removals for the residual emissions that you have. So there's a whole range of solutions depending on what stage of the business journey you're on. And for us at Ecology, we understand that all of this is very personal to every single business, and it's very important to have a direct conversation with someone that can understand where you are in your journey and support you and direct you to the best choice that you may have. So we have a dedicated team that you can reach through a click of a button, and you can tell them their story, and they'll be able to help you. And I think it's really interesting. Us at Ecology, we really care about impact and transparency. That's really at the core. And I think for a lot of businesses, that is so important. And in the way that we've built our platform, you get a public impact profile where you can actually see your forest grow. You can click on every single tree and see its species. You can actually see the actual tree. You can set sustainability goals, which is very important because every single business has something that they're already doing. So it's very easy to display the impact that you already have. We also love a bit of gamification at Ecology. So we have leaderboards and encourage businesses to compete against each other. You can earn badges for the impact that you have. So when you achieve, I don't know, 500 kilograms of carbon or more, you start earning badges, and you can celebrate that with your customers in your community. When you refer another individual or business, you earn sparkly trees, which are very much real trees. But again, we have, I say this as a marketer, but there's a need for storytelling, and businesses need tools to tell great stories about the impact that they have, both to investors and to customers. So that's why everything the story needs to be told in a very attractive way. And that's something that we're really passionate about, and having that transparency so that you can actually see on the impact ledger exactly how many tons of carbon you've removed, or exactly where your tree is planted, see the receipts, see the certificates for your impact. And it's one of the points that Lucas made in the beginning around, there's a chance that there was a statistic around perhaps doing all of this work, how it might impact profitability. And what we see is actually doing this work increases likelihood to book, likelihood to purchase by 30%. So doing this work pays off. And also in doing the actual reduction work of the business, massive efficiency and cost reduction comes out of that as well. So there's so many ways to get involved. I think it's about having that first moment of saying, okay, I'll have a conversation, I'll start out, and then it basically everything snowballs into bigger and bigger impact across the organization.
Great. Yeah, and I've always, and I sound like a broken record on when I talk to our folks here and to our clients, is that, we're going into something like this. There's two other letters in ESG. There's also S and G. And there is the idea that, a weighted factor of your employee engagement, your employees' growth, that people are happy, and we're heading into a downturn. It will be important to, maintain your talent, your top level talent through a shaky time, and taking efforts. And I think it all kind of combines together. Employees are saying they're caring about what their companies are doing from the environment, but they also want to be treated well. They want to be paid fairly. They want, all those type of things. And then from a governance perspective, that if you think of 2008, of all the corruption and things like that would kind of saw come up, and that's what led to things. I think this and ESG has actually helped us guide through that we don't have an Enron surprise us out of nowhere. We kind of know what's going on with companies and what's happening. I think, some of the things you guys brought up, we'll kind of combine the next two questions, and it will be John and Krista focused, but Brian also please chime in. John brought up some of the points that I actually had listed down here about the Supreme Court, basically gutting the EPA in June, and then the deciding vote in the US Senate making a statement this past week that he would not vote for any climate change type things. The other thing that we've seen is a backlash from public officials that has been quite concerning. I think Florida actually, removing exemptions that Disney had because Disney made a statement on a social policy, actually taking the action of voting against Disney, from a government was a new thing. And also we see Texas is now considering banning investment firms that are green focused only. And their government is wanting to take that, consider that action as well. And then we did see yesterday, I believe 10 Congress people, or members of the House of Representatives came out, and basically their campaign is going to be anti-ESG. They are targeting it. They're particularly targeting BlackRock and S&P. And so with that being said, public policy wise, what public policy? What are we going to be looking at here for the next year or two? And if we're heading into a recession, is it now the focus just going to be, the Fed fixing this as opposed to any sort of policy that we might be looking at?
Yeah, so thanks, Lucas. I'm happy to start with that, and interested to hear what other panelists are as well. And this is sort of an emerging area that No, we're getting ready to speak about probably more next year into the next Congress, right? So we always take the perspective that things aren't as good or they're not as bad as they look on the outside. So we've actually been more constructive around the Supreme Court's opinion in West Virginia versus EPA than others on the street, right? The court really limited the holding in that opinion to EPA's powers. This is going to be really wonky, under 111D. And they were very, very narrowly focused on that. They had the opportunity to go much broader and apply major decisions or non-delegation and effectively blow up the regulatory state. They chose not to. Either the majority didn't feel like this was the right issue, or they didn't have the coalition do it. So the ruling is actually fairly narrow. At the end of the day, the EPA can still regulate greenhouse gas emissions. In Q1 next year, they're going to come forward with a rule that's going to make it very expensive to run coal in the U.S. Right? It's not going to be as possibly market focused of anything as the Obama administration's Clean Power Plan, which was thinking about introducing state, regional, and national carbon trading market. It's going to be a top-down control, increase your costs, turn off these units faster. So those types of things are still coming. EPA is still going to regulate tailpipe emissions. That's coming. The administration is basically going to say, all right, we're going to read the opinion. We're going to get our lawyers to think about what's possible, and then we're just going to run it at them, right? And the courts need to send it back to us if they think it's a problem. The other side of the spectrum, yeah, some of this noise is really kicked up because in the US, we're heading towards a midterm election. A midterm election is basically inning number one of a presidential election. So you're seeing people like Mike Pence go down to Texas and speak around woke capitalism and things of that nature. Florida is interesting. Texas is interesting. West Virginia is arguably trying to take the lead in this. We've already seen Texas lock out a number of financial institutions from their municipal market over their unwillingness to extend credit and lending to firearms, right? So now it's being expanded a little bit into the environmental side too as well. I think a lot of this is ESG has done a poor job of communicating what it is, who its stakeholders are, and what its objective is, right? There's a conflation between impact investing, values investing in ESG, and that's not helpful. I'm super lucky in my seat as I speak to one audience, an institutional investor who's putting other people's money to work in a very competitive market where if they're not showing returns in a quarter or 2 quarters, they lose their seat. So for them, ESG is purely a way to drive alpha. It's a way to incorporate additional factors into their investment philosophy. It's been conflated with progressive politics, which is a problem. And I think that needs to be unpacked going forward. We'll see a lot of this heading into the midterm election. And honestly, a lot of the reasons that that's going to happen is Congress hasn't been able to legislate on this. So it's been turned over to the regulatory state, and it's easy to attack the regulatory state. It's not a good place to be, but hopefully the large financial institutions push back, right? They communicate correctly that we're not against coal, we're not against oil, we're making risk-adjusted decisions based on the tolerance within our portfolio. So I think that's the approach. It's not going to go away, but it'll be interesting next year. A Republican Congress, specifically a Republican House, will certainly have hearings on this and bring some institutions in to talk about their investment practices and how they think about coal and oil. So sentiment, not too good, but what's that actually going to lead to? I don't think it's much change. Right? At the end of the day, investors are asking for this information, and companies that are providing it are better situated to capture their capital. So that's how the market works. I'll stop there and turn it back.
Yeah, and Brian, if you want to chime in on, what are you seeing from where are companies looking at what's going on with the government versus what the investment community is saying, or do you see any concerns or change or pivots at all?
Yeah, SEC still has a calendar of other upcoming regulations that will touch S&G. John, you probably published this out to your audience, but we expect more detail on human capital disclosures, potentially on board diversity disclosures. So they're certainly not at the exact end of their schedule for, I believe, October and potentially, is it February or March, more upcoming regulations. The point I was going to get to, though, John, is I think your investor base that you speak to, when they read the SEC proposals around names rule, as well as around some of the ESG-focused disclosures on their portfolios, essentially now they have to define in a regulatory document, what does ESG mean to me? That isn't necessarily going to look like a political statement. That's going to look like this is how we use it to generate alpha. That has to be that way for really for liability purposes themselves. They need to be very careful. Those are obviously very scrutinized statements. So On the other side of my business, NYSE is a sister company of the IDS ICE Data Services division. We actually collect ESG data from an as reported basis. So exactly what companies are reporting out to the market, we collect that and provide it into the investment community. So probably some of the same investors that you face there. We've seen a pretty strong uptick in demand from those investors looking to take that as reported information and use it to make their own definitions, potentially to sit in regulatory documents, et cetera, of this is what we see as strong or weak on E or S or G. I think that rule in itself might step investors away and offer some air cover from those investors that you mentioned might be pulled in front of Congress to see if they can score political points. I think it's very easy for investors, and they can be very clear about this is how we define a strong or weak story, and something that will help us, again, generate value for the investors in those portfolios. I think that's really the wild card here that changes how investors think.
Great. And Krista, you know, I think that really leads us to what a lot of us are curious about, is that Europe, from a government perspective and from a business perspective, is probably ahead of the United States in a lot of ways, but also looks at it quite a bit differently than the United States does. And I'm curious to hear from a European perspective, you know, what do you see from your governments and what's going on there in terms of these type of things, and if you see any road bumps or progress?
Yeah, very interesting question, and also based on what we've just discussed. So, I mean, in Europe, we've seen governments adopt net zero policies, and we've seen a lot of local governments declare climate emergencies. There's been a huge growth over the past 4 years in, for example, in building the electric car charging network in the UK that has absolutely boomed, as well as the cycle path infrastructure, huge areas of growth. Businesses are consistently inviting employees to consider sustainable pension funds, and these are mass changes that are happening. We see, for example, that some countries in Europe, so I'm originally from Romania, I have roots in Germany as well. So the UK, Romania, and Germany already have around a 40% energy mix, renewable energy mix. And yet, I know that the US is only at 20% right now. So there is a different world over the pond. And just to kind of bring that to life a little bit more. So in the last week, we saw a massive landmark where Client Earth, a legal body in the UK, partnered up with Friends of the Earth and the Good Law Project, and they took the UK government to court over their net zero policy and won. So even though the UK is making great strides, the High Court found that the strategy that was set out by the UK government, the net zero strategy, was unlawful because it didn't provide enough detail around how its legally binding emissions target would be met. So the UK government now has 9 months to come up with a new strategy that is even, more rooted in reality and in detail, and they're required to provide that feasible plan for meeting its emission targets. So we're seeing a lot more pressure, even on governments that have declared targets. We're seeing a lot more scrutiny here in the UK, but as you reflected in the beginning, Lucas, we're seeing a lot of consumer pressure across Europe for businesses and governments to take action. We know that 80% of business owners want to be greener but don't know where to start. I know that you highlighted that at the beginning as well, Lucas. A lot of them, a high percentage, over 80%, think that the government needs to do more to educate and support businesses. So there's this pressure on governments to lead the way. We see about a third of them are planning, a third of businesses are planning to make changes to improve the sustainability of their business quickly within the next 6 months. So we're seeing a lot of good work, but also a lot more scrutiny and a lot more pressure from both consumers and investors as well. So yeah, that's the situation here in the UK. Very interesting to see the UK government be taken to court, and it has happened before on other grounds of air quality, and we're seeing more and more bodies across Europe that do that, because you know, a strategy that's not robust, that's not grounded in reality and in detail, is not going to get us to where we need to be, and secure a 1.5 degree world, which we need. So yeah.
Lucas, can I riff off of that for a second? I think, Krista, you essentially defined a net zero target for the UK government, which was a stated target, but potentially didn't meet an appropriate standard. Earlier, you mentioned that 90-10 when it comes to matching up to Science-Based Targets Initiative's goals for a 90% reduction in carbon emissions, with then the potential to use up to 10%, for example, when it comes to abatement using outside assets, et cetera. If you think about that SBTI process, that's really exploded in the last year. So we're at what, I think there's 3,000 companies that they list of all different sizes. But keep in mind that SBTI review, when you take your targets to SBTI and ask for that outside review, one of the items that they review when it comes to setting a scope 3 target is simply, do you have influence over a supply chain, for example? Can you get the rest of your supply chain above a certain percentage, 67, 80%, whatever, to meet that type of goal? That's produced a lot of letters to companies of all sizes where the company is trying to meet that initial SBTI goal to meet investor demand, but then that spiders out into their entire value chain as well. So you think about, you know, you mentioned it from the UK government perspective, going from a stated target to something that's being evaluated. There's a lot more companies now going through that in-depth evaluation, making sure they can actually meet those targets while also starting that pressure. I would say, just from speaking to companies, you're probably at 5x the number of inbounds from members of your supply chain, from customers in particular, this year versus last year, asking, do you have science-based targets? Do you have a net zero target? What are your statements as a company? Because they will be included down the road in procurement decisions. Kind of back to my original theme, those decisions and those goals tend to be set, like an interim goal tends to be set for 2030, 2032, something in that range. And that's going to be very tough once companies have committed to it to step back from. So it is something that is spidering out into the world just simply through the customer and supplier relationship.
Yeah, that's a great point, Brian, because I actually wrote a blog about this a month or two ago where I felt like some people weren't seeing the opportunity with scope 3 emissions, right? Like if you are a smaller organization that has a B2B business model, you are a sustainable organization and in taking sustainable steps, this could be a huge help to you when you're trying to land business from higher, you know, blue chip type companies.
Makes you more competitive.
Yeah, you basically say, hey, we can help your scope 3 emissions data. We can make you look better if you use us. And I think it's a missed opportunity. I mean, I think a lot of companies are starting to realize it, but I think a lot of people aren't putting that together, that could be a huge opportunity for growth and so forth. So I appreciate you bringing that up. And John hit on this a little bit earlier, but the retail investor. So we saw what happened 2 years ago, and probably heard everything, the GameStop and thing that happened, and we're kind of having right now the rise of the retail investor. Some people call it the revenge of the retail investor. What's interesting is that it is a younger group of folks, across the board. It's mainly millennial to younger. A lot of the apps like the Robinhood or a public type app that they're using to do this type of stuff. What's interesting is that this is a generation of people that have only known growth. I mean, if you think about from 2010 to now, maybe a little hiccups here. We went through a pandemic, but rode through it pretty well. They've only known growth, right? What's going to happen to a retail investor, and particularly on the ESG side, where they're weighting these type of things, the first time they see shaky ground and they see their money, they lose some money, or their home value stays flat instead of making, hands over fist money year over year. What do we see from a retail investor side, and particularly with ESG, if we are heading into a market downturn? And this is open. Everybody can take it. Sorry.
I guess I can jump in if no one else does. That initial launch of going to zero commission, you saw probably, every company saw an extra 3 to 5% of their shareholder base now sitting at retail investors. You've also seen just an explosion of the different types of portfolios made available, especially through the ETF space. out to retail investors, and more somewhat you call niche portfolios that are really designed to fit a particular set of values. You can find those all the way down the chain now, hundreds of different types of strategies. I think some part of that is, and when John and I were talking earlier about that, about some of the SEC proposals, really around investor protection. Again, making sure that if you are trying to bring your values into your investment decision, making sure that the investor is actually following those values does come into play from the way the SEC would approach it. As to, I'm not sure if we could really predict what the output would be for that set of investors who are new to the market, who really haven't been around. I don't think it's easy to predict behavior for them, but in general, I think retail investors, if you think about your smart money or faster moving hedge funds or something like that, have tended to trade counter to the market. Retail investors have followed the market a little bit more closely. So you generally see flows maybe following a little bit more, depending on if there's a turnaround of the market versus a deeper drop. But I would say that the universe of the types of portfolios, the types of ways that you can bring your thoughts, values, etc., is now nearing unlimited. There are so many different types of thematic portfolios, impact portfolios, etc., far more than we had in the last downturn. So very tough to equate one to the other.
Yeah, maybe I'll just add a few thoughts on that, and we're kind of rubbing up against the extent of my coverage space here for sure, but I certainly agree that the optionality and the choices here are immense and have never really been there before, down to fractional ownership where you can deploy capital towards a specific value, as Brian meant. I would invest purely in the S factor, purely in retail. There are low cost or zero cost shops that will put that together for you. So however you want to express that can be expressed. I think that's interesting. Another point would be, while ESG evolved from an SRI movement, which was definitely a retail-oriented investment, it's become an institutional asset class now as well. So the larger shops that are really considering factor-based ESG investments, impact, getting funds that can be sold in multiple continents, are positioning themselves to sell in large dollar values to institutional investors who have a longer term outlook and maybe bringing one or two religious or political outlooks to their long-term commitment to capital. So that's growing as well. And then the last point I'll make here too as well, even outside of, this has been kind of equity focused, but there's an entirely new asset class of digital currencies and alternative coins, right, that are in this space too as well, that are currently not super well. The regulatory structure around them in the US remains a question. They're very, very accessible to the retail investor. And they're trying to argue a position in this ESG narrative too as well. Everyone from the coin themselves to the miners of the coins. How are they positioning themselves? Where are they getting that power? Is it renewable based? When they're not mining, can that power be sold back to the grid? Is it offsetting potentially high emissions intensity output from a coal or gas? And so there's so much going on here that it's hard to say how it's going to play out, right? I think that we mentioned at the beginning of the call here that ESG had been biased towards growth. I think that was just the overall market was biased towards growth. In the past quarter and a half, we've seen more ESG value funds come to the market than have ever existed in the space. And I think that's really fascinating because it requires a deeper look at parts of the economy that have an emissions footprint. It's very easy to have a very low scope 1 and 2 intensity if you're looking at healthcare and technology. You can't do that if you're messing around industrials or OEMs or utilities. So that's an interesting transition too as well, that's now available to the retail client.
And just a snippet from me. What we've seen as well over the last year in the market of tree planting projects, carbon and climate solution projects, prices have increased significantly. The demand has grown significantly for projects like these. So yeah, we've seen an almost 2x, 3x growth, which really signals a very strong, healthy, growing market. So.
Great, awesome, thank you. So yeah, there are a few questions, but what I'm going to do then is I'm going to follow with everyone and kind of give the questions I'm seeing in the chat box, and we'll let everyone answer offline since we're kind of running into the time here. What I wanted to do is end it with two different things, but go around robin and start with, where are we a year from today? but say a year from today, we join back together, the same group of people and so forth. It's hard to predict what will happen with the economy and inflation and so forth, but just from our roles as ESG experts and people who believe in this, did I make the right decision joining this world 2 or 3 years ago, or am I having to explain to my wife why I'm having to pivot again? So where are we a year from now? Do we see progress or do we see some stalls? And I will start with Brian.
Okay. I'll always take that. One I can guarantee is I'll have a little bit more gray hair than I did at this point. But beyond that, you see the progress when it comes to the interdependencies of companies. Even if you don't have an SEC rule that goes full into mandatory disclosures or something that's in place by then, one thing I'll say is companies are now measuring this information and measuring it in a standardized format, even if they're not disclosing everything that's fully out there in a Form 10K filing. I'd say that is not slowing in any sense. And in fact, as I hear a lot more companies talking to, for example, their internal audit teams for the first time, if I need to collect human capital information and report it on a standardized basis, how do I do that and make sure that I meet something that could meet an audit requirement down the road? I think that's underway no matter what. I think there's a certain amount of this that is just naturally going to be private ordering based on how the investment community operates. Beyond that, inflows, outflows, I think over the long run, we've always seen this here as NYSE is essentially what you're doing from ESG investing perspective is simply look at what are the items that are not on the financial statements that could have a financial impact. Over the very long term, ESG investing maybe just becomes investing. It's just simply taking the pieces that we haven't done the best job accounting on. And then finally, harmonization. We talked about SEC, but obviously, Krista, ISSB, FRAG, all of those organizations are trying to line up the timing when it comes to climate disclosures. They're all obviously speaking with one another. The hope is we get to one report that can be read by many when it comes to companies instead of many reports being read by many. That would be the goal for many of my listed company issuers that obviously just don't want to have to do any more work that carries a certain level of liability, but doesn't generate more value for their stakeholders.
John?
Sure. Yeah, absolutely. I'm try and follow up on that one. Brian, I really like the concept of moving ESG out of a silo and it becoming one part of the mosaic theory of investment. I'm not an optimist by birth or domicile here in DC. I don't see that in the next year. That would be great if that's where this ends up, right? I think that's what this makes the most sense, right? This is using non-commoditized, non-financial information to make better investment decisions. That's great. I think in the next year, right, I think there's still gonna be a lot of questions, right? This space is so evolutionary that what we're talking about is always changing. So therefore, even though there's been so much progress, we still feel like, oh my gosh, there's all these things that need to get done. So that's kind of out there, I think for sure. But that being said, disclosure will increase, either voluntary or mandatory. And I think that in the next year and a half, there's gonna be much better ways of capturing ESG data sets into traditional financial models, such that the financial institutions can better understand this. If you can't model it, there's a whole core of individuals who don't understand it, don't want to understand it, and can't put it into their investment outlook. As soon as you can begin to do that, be it cost of capital or sort of revenue growth or net cost reductions, that's a game changer in the space. And I think that could really begin to emerge in the next year and a half.
And Krista, I mean, from a European perspective, in the next year, what do you see shaking out for y'all and from the whole planet as a whole?
Okay, well, I'm an optimist by nature. It's how I can make it in this field, and it's really interesting because I was at COP26 last year in Glasgow, the biggest climate conference, and I was in those rooms hearing the negotiations that were happening at the highest level between presidents of different countries. And one day we were like, oh, we're at 3.2 degree global warming. Next day, 2.7. The day after that, 2.2. So progress is happening. And I think what's really interesting, one of the questions that came, I think, on the chat is, where do you start? And I think starting by understanding what's happening in your house, and from our perspective, you know, calculating your carbon footprint, understanding what your current impact is a first step. What's really interesting is, I know, you know, I come a lot from the area of environment, but the reality is when you look at environmental impact, that is intrinsically connected with social and governance as well. Everything goes hand in hand. And a lot of the time, some of the projects that we fund benefit, we've had projects that have benefited all 17 SDGs, just to show how one project can have such a huge impact. So I think it's really important to also focus on the fact that technology is also advancing super quickly. One of the things that we're just launching right now at Ecology is a carbon accounting tool, where essentially, if you're a small business, you can literally plug your whatever you're using to calculate your accounting system. If you work with QuickBooks or with Xero, you can essentially plug that tool into Ecology Zero, and that essentially shows your carbon footprint, and you're able to see all of your suppliers, which is what Brian and John talked about earlier. In terms of that supply chain, you're going to be able to see what suppliers have the biggest carbon impact, and then you're going to be able to see what competitors provide the same value for you, but a better environmental impact. So it's a very exciting time that more and more technology is starting to emerge to support businesses through that journey. And again, someone else reflected on greenwashing, and I think this is the biggest message that I have to highlight here. Do not be afraid to take a step forward because of greenwashing. I think that can be tackled very easily through having a very humble tone as a business. You don't need to be overstating, overclaiming. Everything is a journey. In my last few weeks at Heathrow, we launched this campaign talking about needing to tackle the elephant at the airport, climate change. And we would use wording like, Heathrow has reduced 93% of its carbon emissions since 1990, but we're not stopping there. We know that there's a lot more work to do. So as long as you compensate your achievements by saying the journey ahead is long, then you're in a safe place. So what I would say, just to end, is we need thousands of businesses to do ESG sustainability imperfectly. We don't need a handful that do it perfectly. We need the many, not the few.
That's a great point. And I think that's what we try to convey to a lot of our clients at Gateways. This doesn't need to be perfect. You don't need to be checking every box. Let's just start somewhere and get some messaging out there and make sure we're going down that road. So we have a minute left, so we'll try to do this quickly. I want to give each of you all just a final plug of what you and your organization are working on, and then we will kind of conclude from there. So let's start with John.
Sure, absolutely. So at Cowen, ESG is embedded throughout the organization and the products and services we're attempting to deliver to the market. So on the research side, it's identifying outperforming companies by understanding their materiality framework and assessing that. And on the banking side, it's allocating capital to those marketplaces. In my desk, it's on the policy space, and it's going to be volatile for the next 2 years. And we're setting up for another interesting 2024 presidential run.
Great. Brian?
I always try to bring this up in the right audiences, but that data set I mentioned earlier that my ICE parent company collects in terms of ESG data reported by companies that's used for investment decisions, we actually make that available for free to NYSE listed companies to use for benchmarking purposes. So if you're NYSE listed, feel free to reach out. Glad to put it on your desktop and hopefully use it to help you decide the right ramp for disclosure for your company as well.
Great. And Krista, I'm excited about your organization, but if you just give us a little final plug, and then we will conclude.
Sure. So yeah, head to ecology.com and get in touch with our colleagues. There's a lot that we can do to help you get started on your sustainability and ESG journey, from making your product carbon neutral or starting your net zero journey, starting to fund climate solutions and projects across the way. There's a solution for every size of business. We're here to support you.
Thank you. And thanks you to all three of y'all. And thank you for everyone attending today. We're hoping to keep this going and do other panels. If you want to give me feedback, you can certainly see my email address on the press release and contact me and give me feedback or give me other topics that you would like to explore. And if you have any follow-up questions, I will certainly try to connect with our panelists on other questions that might be out there. But we are very excited about this. Gateway is really excited about bringing this initiative to our clients and to new prospective clients, and we hope to continually have more information. So I'll give everyone back their day, and thank you again. I appreciate it. Thanks, guys.
Thank you so much.